The last topic that we want to cover is portfolio management, and the key concepts that we'll be covering are asset allocation, diversification, and rebalancing. We want to focus on asset allocation because it might be the single most important thing an investor can practice. It's how you divide your portfolio between stocks, bonds, and cash, and it does have a big impact on your long-term returns because this is something that will be adjusted over time. The two key factors, your risk tolerance and how many years you have left before retirement. We all need to be disciplined when it comes to saving and investing. Retirees should plan on having enough money to last for 20 plus years in retirement. That's why this one is very important. The current life expectancy for both men and women are in their mid-80s, and so if you retire in your 60s, that's where the 20 plus years come from. And it right shows a few different combinations of how these stocks, bonds, and cash allocations can be adjusted. And what we want to do is provide you with an example. And it's this step 1, 2, 3, 4. In step 1, the early accumulation phase is when your stock portion is going to be at its largest. That's because you can take on more risk because you have a longer horizon for retirement. You're in your youth. Number 2 is the mid-accumulation. This might occur when you're in your 40s and 50s and your stock allocation is reduced and your cash and bond allocation is slightly increased. When you're in step 3, which is pre-retirement, this might be when you're in your 60s, it might be a more even distribution between the three asset classes. And in retirement, cash wants to be the largest portion of your portfolio. You're still going to have some bonds and a few stocks, but right now you are in a very conservative and stable phase. And so these are the accumulation phases that Money Wonk uses. And remember, even through all of these phases, you still want to save and contribute on a regular basis, and you still want to set investment targets based on what the return on investment is, and you want to be able to aim and adjust those targets over time. In your 20s and 30s, you're going to have an aggressive investment style, most people. When you're in your 40s and 50s, the style will turn from aggressive to moderate. And when you're in your 60s, you want to be very conservative. Your time horizon is very short, and you don't want to have the market have an adverse effect and lose money. So here we go with step 1, 2, and 3. This is accumulation phase, and the allocations are majority stocks in phase 1, kind of evenly balanced in 2 and 3. And that is because when you get into step 4, which is the distribution phase, you want to be mostly in cash. So you're building up to where you retire in your 60s, and then you start with the withdrawal and distribution phase. So we want to concentrate on mutual funds because they offer a simple way to diversify your portfolio. I want to take you step by step in managing a portfolio that is well diversified and has a simple asset allocation. And I'm going to use index funds in this example because they typically offer lower maintenance fees, and that is going to be an important consideration. The fees that you pay to have your money invested. And the portfolio mix we're looking at is a stock portfolio, which includes number 1, 2, 5, and 6, domestic, real estate, foreign, and emerging, and your bond or cash portion, which is in step 3 and 4, which is the TIPS and your U.S. Treasury bond fund. So diversification, reducing your risks. A diversified portfolio is less risky than a portfolio that is concentrated in one or fewer investments, or even one or more mutual funds. Diversification is spreading your money amongst a number of different types of investments. It lessens your risk because even if some of your holdings go down, others may go up or go up less than they might go down. On the flip side, a diversified portfolio is unlikely to outperform the market. That's because we're mixing stocks and bonds, but we're also reducing our risk, which implies a reduced return and hence a balanced investment approach. And so if we look, for example, at what would be called a 70-30 mix, 70% in stocks, 30% in stocks in bonds and cash, what you'll see here is we've got 30% in domestic, 20% in real estate, 15% in foreign, 5% in emerging. That makes up your 70% of your stock portfolio. And then in the gold and orange pie portions, we've got 50% each in treasuries and bonds. That's an example of a 70-30 mix. And the last concept that we want to talk about is we create that mix in the beginning of the year, but as the market goes through its gyrations throughout the year, that mix is going to change. Perhaps the stocks go down, emerging market goes up. So what we want to do is we want to see where we are at the beginning of the year, and we want to see where we are at the end of the year. And typically the rebalancing will occur on an annual basis back to your targets. So stocks will often gain more than bonds or cash, and as a result, stocks will probably take up more of your portfolio. Because stocks are riskier investment than bonds, your portfolio becomes riskier as your stock portion rises. That's why it's important to rebalance and restore your position in your portfolio to its original pattern. In addition to rebalancing your portfolio, you want to keep tabs on your individual investments. With stocks, you want to keep your tabs on the price and where that price is relative to the targets that you've established. And rebalancing your portfolios, this is what it would look like if we came back to our original positions. The blue, which is domestic, might have dropped to 29. We want to bring it back to 30%. The purple, which is emerging markets, originally it was 5%. It grew to 8%, so we'll want to rebalance it back to the original targets. So you add up all of the balances and determine your current asset mix, including cash. Your goal is to have a specific asset allocation. If it gets out of balance by plus or minus 5%, some folks believe it's a good idea to rebalance back to your targets. Keeping your asset allocation in a reasonably targeted range could cause you to make adjustments to your holdings maybe 1 or 2 times a year, but the goal is to restore it to your original allocation. And the long and short of it is we want to have a long-term focus, maintain low costs, and be very disciplined. Investing is putting money into something with the expectation of positive gains, usually over a long period of time, and providing income from those investments. All forms of investments involve some form of risk, and building a portfolio of diversified assets is meant to reduce or avoid unnecessary risks, but ultimately, better investing decisions can be made if you think long-term and plan ahead.